Okay, so in this example, this is for our tax class. We are looking at Chapter 7, Property Acquisitions and Cost Recovery Deductions. This is from the Principles of Taxation for Business and Investing Planning, 2012 edition. So let's look at 7.4. And 7.4, in 2010, Firm A paid $50,000 cash to purchase a tangible business asset. In 2010 and 11, it deducted $3,140 and $7,200 depreciation with respect to the asset using makers, of course. Firm A's marginal tax rate in both years was 35%. So in Part A, we want to compute Firm A's net cash flow attributable to the purchase of the asset in each year. And Part B, confirm or compute Firm A's adjusted basis at the end of each year. So we're just talking about the cost of the assets here. So to start off, we're going to figure out our cash flow attributable to the purchase. In 2010, obviously we're going to have the cost of the asset is going to be a cash outflow. My depreciation is going to be a savings on that because it's going to reduce my taxable income, and as a tax deduction, we're going to take our first year depreciation of 3,140 times 0.35, which is our marginal tax rate. So our tax savings is $1,099. So we're able to get that depreciation tax dollars and 35% of that. So that's a good tax savings. My net cash flow for the year is going to be, I'm just going to auto sum this. So we'll add these two numbers together, and 48,901 is my negative 48,901 is my net cash flow for 2010. For 2011, I've already paid for the assets, so there's no cash outflow there, but I do have my depreciation savings. So my depreciation was $7,200 times my marginal tax rate of 35% gives me a $2,520 net cash savings. So it's an increased cash flow in year 2 from the savings on that cost deduction. Okay, so let's look at Part B. Compute Firm A's adjusted basis in the asset at the end of the new year, or end of each year. So our initial basis is generally always going to be the cost or the value of the asset, or if it's an exchange. So if we gave them $50,000 worth of securities or land, that fair market value would be our initial cost basis. Our year 1 depreciation was 3,140, so we're going to subtract that. That's going to give me, again, I'm going to auto sum, an adjusted basis at the end of the tax year 2010 of $46,860. My year 2 depreciation is $7,200, and my end of the year of 2011 basis is going to be the $46,860 minus our $7,200, so my new basis is $39,660. So basically, our basis is the net realizable value. Okay, so that's what our cost basis is. If we sold our asset at the end of the year of 2011, that would be my adjusted basis that I would use for taxable purposes to record my taxable gain or loss on that transaction. Okay, so let's go a step further. We're going to go down to problem 7-5. Okay, and 7-5, we're going to use the same facts. So we paid $50,000 for an asset, except for Firm A borrowed $50,000 to purchase the asset, and each year it paid $3,800 annual interest on the debt. The interest payments were deductible. How does this change the facts from the net cash flow attributable to the asset purchase in each year? And how does this change? Part B is, how does this change affect the adjusted basis at the end of each year? So let's look at the cash flow. I better put 2010 and 2011. So sorry about that. We'll center center that, and need to format that better. I'm sorry, I get kind of picky about this nonsense. Okay, so my initial cost of the asset is $50,000. So that hasn't changed, but my cash flow actually increased. If you remember back to doing cash flow statements in our regular accounting class, we had proceeds from the debt, so that our net cost here is zero in cash flow dollars. My interest expense in the first year, which is going to be deductible, is $3,800. Okay. My tax savings is going to be my interest deduction, $3,800, times my marginal tax rate of 0.35. So I have a tax savings of $1,330 the first year. I also have my depreciation tax savings. So again, I'm going to have my depreciation of $3,140 times 0.35%, so that's at $1,099. My net cash flow, if I sum all this up from the top on down, is I'm going to have a cash outflow of $1,371 because we had the interest expense that we actually paid, cash interest expense of $3,800. So my net cash outflow is $1,371. Okay. In year two, I still have a cash outflow of $3,800. My interest savings is going to be the same. So same marginal tax rate, same deduction. Okay, my savings, again, that we calculated in number 4, we had $7,200 of depreciation expense times my marginal tax rate of 35%. Gives me $2,520. My net cash flow, you can do this easy way, copy it over, is $50. So I had a $50 positive cash flow from that. And this will extend out until the length of the asset or however long our loan is. If it's a loan that it's obviously a loan that we're paying the principal off at the end of the debt. So therefore my cash flow would then go down $50,000 whenever we paid off that particular debt. So when we calculate the cost savings, if we want to buy versus lease, we would do all this across each year for my cash flows and then see which one and net present value of that is going to be worth the most to us. Part B, how does this change? Facts affect our adjusted basis of the asset at the end of the year. And I'm hoping that you know that the use of leverage has no effect on their adjusted basis of the asset, because that does not change how we're financing it, does not change the basis. It's still going to be the cost minus our depreciation that we take each year. Okay, it does affect our cash flow. So this is again some basic determinations of using the cost of assets, our base, and determining our bases and our cash flows.